8%, 5%, in a single session. Sandisk and Micron just got crushed. Panic selling or buying opportunity? Micron after a 5% crash, analysts say buy. March 27, 2026. A day memory stock investors will remember. Sandisk down 8%, Micron down 5%. In a market that was otherwise flat, memory stocks got slaughtered. And it wasn't just Sandisk and Micron. The entire memory sector caught a cold. Investors were running for the exits. But why? What triggered this sudden panic? The answer came from Mountain View, California. And it has a name that just struck fear into the hearts of memory investors. TurboQuant, Google's new AI optimization algorithm. And according to early reports, it could reduce AI memory requirements by up to 6 times. Let me explain what this means. Today's AI models are memory hogs. They need massive amounts of HBM, high bandwidth memory, to function. That's why Micron, SK Hynix, and Samsung have been printing money. Wall Street did the math. If AI memory demand drops by 80%, the current pricing and supply shortage narrative collapses, hence the panic selling. But TurboQuant wasn't the only reason memory stocks dropped. Sandisk made a move that, really spooked investors. $1 billion. Yeah, that's the number flashing in everyone's minds. On paper, this gives Sandisk access to Nanya's DRAM production. Smart move, right? But investors are worried about timing. Taiwan is a geopolitical flashpoint, and honestly, trade policy risks are higher than ever. Is Sandisk making a bet they might regret? Then there's Micron. Their crime? Spending too much. The company's capital expenditure guidance came in higher than expected. When a memory company spends heavily on new fabs, it usually signals they expect demand to rise. But it also pressures margins. Investors hate uncertainty, and high Capex creates, even more uncertainty. And there's more. SK Hynix, Micron's biggest competitor, is exploring a U.S. listing. If they list on a U.S. exchange, American investors will have direct access to SK Hynix stock. That's more competition for investment dollars. So with all this bad news, why are analysts still bullish? Let me show you what they're seeing that the market might be missing. First, supply shortage. Memory manufacturers are running at full capacity. There's no excess inventory. When demand returns, there's no cushion. Prices will spike. Second, customers are prepaying. In the memory industry, prepayment is the ultimate signal of confidence. Customers don't give you money up front unless they're desperate for your product. Third, valuation. Micron is trading at 8 times forward earnings. The PEG ratio, which compares PE to growth, is 0.3. Anything under 1 is considered undervalued. 0.3 is, honestly, screaming cheap. Fourth, margins. Both Sandisk and Micron are reporting gross margins between 65 and 67%. Those are Apple-level margins. In the commodity memory business, those numbers are unheard of. And here's the biggest reason analysts aren't panicking. AI infrastructure spending isn't stopping. Google's TurboQuant might reduce memory per model, but the number of AI models is exploding. Every company is becoming an AI company. Every industry is deploying AI. Even if TurboQuant cuts memory per model by 80%, if the number of models grows 10 times, total demand still rises. The memory industry has always been cyclical, booms and busts. The question for investors right now is this the start of a bust, or just a temporary panic before the next leg up? So, who's right? The market selling off on TurboQuant fears, or the analysts betting on long-term AI demand? The answer will come in the next few months. AI infrastructure spending data will tell us whether Google's algorithm is a game changer or just noise, whether Sandisk's Nanya bet pays off or backfires, whether Micron's Capex is genius or reckless. One thing is certain: memory stocks are volatile. But for investors who understand the cycle, volatility is opportunity. The question isn't whether AI needs memory. It's whether you have the stomach to hold through the panic.